Thinking about investing can be daunting. We worry about fees and we worry about losing money. According to our recent BlackRock Global Investor Pulse survey, most of us still hold a large proportion of our wealth in cash, and many of us feel less confident about our financial decision making than we did even just 1 year ago. At the same time, more and more of us are saving for retirement. But in the UK's rapidly evolving pension landscape, how many of us are really on track to achieve financial security in old age? What does this even involve? And why are we so ill at ease with financial planning when, like with the dentist, the longer you put it off, the worse it could get? One of the key challenges people face is how to imagine retirement, which may be decades away. Each generation is living longer and many of us can expect to live beyond 100 years. However, many dramatically underestimate just how long they might be around for. In an ideal world, we would like 39 years to save for retirement. In the real world, many of us put it off until well into our 30s or even 40s, while around 1 in 5 never start saving at all. Most of us typically save around 7% of our annual salary for retirement. But even this amount might not be enough to achieve the income we would like in retirement. When it comes to financial priorities, our instinct is to feather our own nests. Saving in general, saving towards retirement and growing wealth are 3 of the top 5 financial priorities. Yet despite this mix of short-term and long-term financial goals, we are still reluctant to invest more of our money. Around 2/3 of all personal savings and investments remain stuck in cash, which is not surprising as we have fewer doubts or concerns when opting for cash. However, given the current and low interest rates from cash and bonds, saving and investing for particular goals has become more challenging than ever before. Of course, moving out of cash means taking on more risk. For those looking to invest, or for those who are doing so already, the tendency to invest closer to home and in areas we might know well seems intuitive. However, the benefits of diversifying or spreading investments away from home can far outweigh the risks. Many studies have shown that the allocation of investments across multiple assets is far more important than choosing which specific companies you buy. One simple starting point for diversifying or spreading your investments could be by looking at well-known markets such as the FTSE 100 or the S&P 500. These markets give you exposure to some of the largest UK and US companies as measured by their market value. Using an exchange-traded fund, a fund which trades on a stock exchange and can be bought or sold throughout the day like any stock to invest, enables you to invest in the broad market index with one simple trade, rather than having to buy each of the individual stocks which make up the index. Using this principle, you can look to further diversify investments across different markets, geographies, sectors and assets, including shares, bonds, property shares and even commodities such as gold. Within stocks, you have a choice of broad regions or single countries, or sectors or different investment approaches, or even company sizes. When investing across assets, it is important to understand the benefits and additional risks this brings. Stock markets in general tend to increase in value when the economic outlook is favourable, but tend to decline when the economic news is less positive. Meanwhile, bonds have historically reacted in an opposite manner, tending to decline in value during favourable economic conditions, but rising in value when the economy takes a downward turn. When investing overseas, it is important to note that you will also be exposed to the fluctuations of different currencies. The decision on what proportion to invest across different assets will depend on your objectives, your time horizon and your appetite for risk.